We're watching the commodity market today. There's been plenty of volatility in oil prices. Crude closing the day with modest gains after being up as much as 2%. Joining us now, Daan Struyven, Goldman Sachs Managing Director and Head of Oil Research. Daan, thank you for being here. As we were talking about earlier, there is now this OPEC Plus agreement reportedly to push off the kind of production increases that had initially been talked about here. Why didn't we see a more sustainable gain in oil prices from that report?
Great, it's great to be on. Thank you for having me. So I think two reasons, why we saw only a modest increase in prices in response to the news. First, I think that following earlier reports, including yesterday, that OPEC officials were strongly considering to delay the production increases. I think some of the news was already priced in as of today. And I think the second increase is that it's about delaying relatively small production increases by 2 months. And so the reduction in expected supply is only moderate.
I'm interested, Daan, just on the demand side of the equation, we obviously talk a lot about the weakness out of China. We've also gotten some downbeat economic data out of the U.S. I mean, I'm interested, what does the demand picture in the U.S. look like?
So the summary on demand globally is weakness in China, as you alluded at, but resilience in the world outside of China, especially in the U.S., but also, for instance, in Europe and in India. In places like the US and Europe, we are seeing relatively firm oil demand for products such as gasoline and jet fuel related to the service sector and related to the consumer, which is the part of the economy that is outperforming, is doing better than the manufacturing sector, which tends to rely more on diesel oil, which has been coming in softer globally in the US, but also in China.
So, Tom, put it all together for us. What are you all expecting for oil, both in, say, the 3-month time horizon, but then talk to us about the longer run, maybe the 12-month horizon also?
Perfect. So we continue to stick to our range-bound view for oil prices. We think that Brent will remain in the 70 to 85 range, with our December 2025 target at $74 per barrel, so pretty close to current prices. In the short term, we assume a modest pickup in prices because oil looks somewhat cheap relative to the level of inventories, and because we also assume that the market will be in a deficit in September and October, in part because of a disruption to Libya supply this month.
You know, Daan, demand is obviously a part of the story here, a big important, and maybe the part of the story. I'm curious, though, about how you're thinking about geopolitical risk, which is also front and center. I mean, you look around the world, Daan, and Russia, Ukraine, Israel, Hamas, China, Taiwan, Houthis. But it seems, I guess, like the oil market is saying, aware of that, but that it simply believes demand is still the story here.
So if you take a step back and look at how oil prices have moved over the last 2 years, you have sort of been swinging in a roughly 70 to 90 range as the market has been going back and forth between concerns about downside risk to supply because of geopolitical tensions, on the one hand, pushing you to the higher end of the range, and on the other hand, concerns about potential downside to oil demand as recession fears have sometimes come back into focus. I think that over the last few months, the focus has shifted back from downside to supply from geopolitics to downside to demand, in part because we have to recognize that despite ongoing conflicts, both in the Middle East and in the Russia-Ukraine region, two big oil producers, we haven't seen significant, persistent, actual drops in oil supply from these countries. And second, even if we were to see a potential supply disruption, with a lot of spare capacity in the global oil market, roughly 6 million barrels per day of spare capacity, in many geopolitical disruption scenarios, OPEC countries such as Saudi Arabia and the UAE could step in and fill in the gap and offset the tightening effect from disruptions elsewhere.
And Daan, you wrote recently about the interplay of AI and oil. And there's been a lot of attention on power use related to AI this year. But going forward, what do you think is going to be the implication for oil companies specifically from the whole AI story? Sort of what would be your biggest takeaway?
Great. So we do think that the emergence of AI will boost overall energy demand, especially for power. But for oil, oil is currently barely used to generate power. We largely rely on natural gas, renewables, and nuclear in the US to generate power. And so actually, while the impact on power prices and natural gas prices is likely going to be positive because of a boost to power demand, we actually recently estimated that the impact from AI on oil prices is likely going to be modestly negative on net, because AI should help to lower oil production costs, as AI helps to basically make drilling more efficient and make it cheaper to produce oil. And so we think that the negative impact on oil prices from lower production costs and better technologies will likely outweigh a slightly positive demand impact on oil from higher incomes as AI sort of boosts productivity and incomes across the world.
Daan, I want to switch gears here. Last question, get your take on gold. Bullion surged about 20% this year, Daan. You know, investors betting the Fed's going to ease. Of course, that geopolitical conflict we've been talking about. Where do you see the metal headed from here, Daan? What are you telling clients?
We're really quite bullish gold. It's our preferred long expression in commodities right now. We expect gold to rally to $2,700 by early next year. We think that in the base case, gold should benefit from imminent Fed cuts, which is a key structural support. And structurally, we do think that emerging market central banks, since the invasion of Ukraine by Russia in 2022, are structurally going to buy more gold, as we've learned that their dollar reserves are not necessarily safe. So a base case with a lot of demand support pushing gold higher, but also in risk scenarios where you get geopolitical escalations, potentially a recession, gold would likely also perform very well. So it's a good investment both in the soft landing Goldman base case and in alternative downside scenarios as well.
Win-win. Daan, thanks so much for being here. Appreciate it.
Thank you.